On February 24, 2023, SVB Financial Group filed its annual report with the Securities and Exchange Commission. In Note 6 to the consolidated financial statements, the bank disclosed that its held-to-maturity securities portfolio, approximately $91 billion, had a fair value roughly $15.5 billion below its carrying value as of December 31, 2022. Total shareholders' equity at that date was approximately $16.3 billion. The unrealized loss on one line item in one footnote was nearly equal to the entire equity base of the company. 12 days later, the market noticed. This is the story of the document that disclosed the number first, the filing that forced the market to confront it, and the final 36 hours that ended with Silicon Valley Bank in receivership. SVB Financial Group's Form 10-K for fiscal year 2022 was filed with the SEC on February 24, 2023. The note disclosed two portfolios. The available-for-sale portfolio, about $26 billion, carried an average yield of 1.56% and an average duration of 3.6 years. The held-to-maturity portfolio, about $91 billion, largely agency mortgage-backed securities, carried an average yield of 1.66% and an average duration of 6.2 years. The fair value of the held-to-maturity portfolio sat approximately $15.5 billion below its carrying value. SVB's total shareholders' equity, on a different page of the same filing, was approximately $16.3 billion. The two figures were never placed side by side in the document. They did not need to be. Both were already public in the same annual report, available to anyone who read both pages. On March 8, 2023, 12 days after the 10-K, SVB Financial Group filed an 8-K with the SEC. The filing disclosed that the bank had sold a portfolio of available-for-sale securities with a book value of approximately $23.97 billion for net proceeds of approximately $21.45 billion, a realized loss of about $1.8 billion, and was launching a $2.25 billion capital raise, anchored by a $500 million commitment from General Atlantic, a longtime client. The press release attached as Exhibit 99.1 described the loss as a one-time event, with the reinvested proceeds expected to produce an estimated $450 million improvement in annualized net interest income. Nothing in the filing used the words liquidity crisis. Nothing in the filing referenced Note 6 of the 10-K filed 2 weeks earlier. It did not need to. For a depositor base concentrated among venture-backed technology companies that talk to each other constantly, the 8-K gave the market a reason to reread the footnote that had been sitting in the 10-K since February 24th. Under US accounting rules, securities a bank intends to hold until they mature are recorded at their original cost, not their current market value. Unrealized losses on those securities don't reduce net income or reported equity. They exist only as a footnote disclosure of fair value. SVB's available-for-sale portfolio worked differently. Those securities were marked to market, with unrealized losses already reducing the bank's reported equity. The held-to-maturity classification was standard accounting used by banks across the industry. It was also the reason a $15.5 billion gap between cost and fair value could sit in a footnote for an entire reporting cycle without touching a single regulatory capital ratio. As long as the bank never had to sell those securities, the losses existed. The accounting rules allowed the bank to keep them in a footnote instead of on the face of the balance sheet. The March 8th sale came entirely from the available-for-sale book. The held-to-maturity portfolio, carrying the larger unrealized loss, stayed on the books at cost. Large discretionary sales from a held-to-maturity portfolio can jeopardize that accounting treatment and potentially force the remaining portfolio to be reclassified, which would mean recognizing the loss against equity immediately. SVB did not sell from the held-to-maturity book on March 8th. It did not need to. The footnote that mattered was already public, and the 8-K had just given the market a reason to go back and read it. In the days before March 8, 2023, Moody's Investors Service notified SVB Financial Group that it was preparing to downgrade the bank's credit rating, reportedly in connection with the unrealized losses on the securities portfolio described in the 2022 10-K. SVB's board and management, according to subsequent reporting cited in the Federal Reserve's April 2023 review, accelerated the timeline for the securities sale and capital raise in response. The 8-K was filed on March 8th. That evening, Moody's downgraded SVB Financial Group by one notch to Baa1, still 3 notches into investment grade. The downgrade was one notch. The reaction would not be. By the end of the trading day on March 9, 2023, SVB customers had submitted withdrawal requests totaling approximately $42 billion, according to the California Department of Financial Protection and Innovation's order placing the bank into receivership and subsequent congressional testimony from Vice Chair Barr. Bank management told regulators that morning that it expected an additional $100 billion in outflows on March 10th. SVB Financial Group's total deposits at year-end 2022, as reported in the 10-K filed 2 weeks earlier, were approximately $173 billion. The $42 billion that left on March 9th represented close to a quarter of that base, withdrawn in a single business day, through electronic transfers initiated by depositors responding to the same public signals at the same time. On the morning of March 10, 2023, the California Department of Financial Protection and Innovation issued an order taking possession of Silicon Valley Bank and appointing the Federal Deposit Insurance Corporation as receiver. The FDIC created a new entity, the Deposit Insurance National Bank of Santa Clara, to hold insured deposits, and announced that uninsured depositors would receive a receivership certificate for the remainder of their funds, with no commitment at that point on timing or amount. That evening, Moody's downgraded SVB Financial Group by 13 notches in a single action, from Baa1 to C, the rating agency's designation for default. The bank that filed an 8-K describing a balance sheet repositioning on Wednesday morning was, by Friday morning, a receivership case file. The Federal Reserve Board's Office of Inspector General's Material Loss Review of Silicon Valley Bank found that the failure was expected to cost the Deposit Insurance Fund approximately $16.1 billion. 2 days after the receivership began, the FDIC, the Federal Reserve, and the Treasury Department jointly invoked a systemic risk exception to guarantee all deposits at SVB and at Signature Bank, including amounts above the standard $250,000 insurance limit. A separate FDIC assessment tied most of the combined cost of the two failures to that decision. The Material Loss Review attributed SVB's failure to its concentrated depositor base, overwhelmingly uninsured, overwhelmingly technology sector, and overwhelmingly networked, combined with a securities portfolio whose interest rate risk had been disclosed in detail in the bank's own public filings for at least a full reporting cycle before anyone outside the bank treated those disclosures as material. On April 28, 2023, the Federal Reserve Board released its review of the supervision and regulation of Silicon Valley Bank, led by Vice Chair for Supervision, Michael Barr. The report stated that Federal Reserve supervisors at the San Francisco Reserve Bank had identified deficiencies in SVB's interest rate risk management and liquidity practices through normal examination work, issuing supervisory findings, matters requiring attention and matters requiring immediate attention, before the bank's collapse. The report's first finding was that SVB's board of directors and management failed to manage their risks. The second finding was that Federal Reserve supervisors did not fully appreciate the extent of SVB's vulnerabilities as the bank grew. The third finding was that when supervisors did identify vulnerabilities, they did not ensure the bank fixed them quickly enough. SVB's CAMELS rating, the confidential supervisory score regulators assign to every bank, included a component for sensitivity to market risk. The Barr Report found that supervisors had planned to downgrade that component from satisfactory to less than satisfactory as part of the bank's 2022 examination. The downgrade was never finalized. The bank failed first. The Federal Reserve's April 2023 review included a fourth finding that went beyond SVB itself, that changes to the Fed's tailoring framework following the Economic Growth, Regulatory Relief and Consumer Protection Act of 2018 had reduced supervisory standards and promoted what the report called a less assertive supervisory approach for banks of SVB's size category. SVB Financial Group, with roughly $209 billion in total assets at the time of its failure, sat just above the threshold at which the most stringent liquidity and capital requirements would have applied under the pre-2018 framework. The report did not allege that any individual examiner failed to do their job. It alleged that the framework those examiners operated within had been adjusted in a way that left a bank holding $91 billion in held-to-maturity securities, with a $15.5 billion unrealized loss disclosed in its own footnotes, subject to a supervisory regime that did not require it to hold capital against that loss. On February 27, 2023, 3 days after the 10K and 9 days before the 8K, SVB Financial Group CEO Greg Becker sold 12,451 shares of company stock for approximately $3.6 million, according to a Form 4 filed with the SEC. The sale was executed under a Rule 10b-5-1 trading plan, which Becker had adopted on January 26, 2023. Rule 10b-5-1 plans are designed to give corporate insiders an affirmative defense against insider trading claims on the condition that the plan was adopted at a time when the insider was not in possession of material, non-public information. At the time the plan was adopted, the Federal Reserve's April 2023 review notes that SVB had approximately 30 unresolved supervisory findings open with its regulators. Whether those findings constituted material non-public information for purposes of the trading plan is, as of this filming, a question that has been raised by members of Congress and referred to the SEC and the Department of Justice, and has not been resolved in any public enforcement action. The facts on the record are the filing date of the plan, the date of the sale, and the gap between them. What those facts mean is still an open question in the public record. The 8K filed on the morning of March 8, 2023 was not the document that killed Silicon Valley Bank. The document that mattered was filed 12 days earlier, the 2022 Form 10K, Note 6, available for sale and held to maturity securities, a $15.5 billion gap between cost and fair value, sitting against $16.3 billion in equity. The public was told the bank was repositioning its balance sheet for a higher rate environment. The filings show a bank whose largest asset category had lost value equal to nearly its entire capital base, under an accounting standard that did not require that loss to be recognized, until a sale, a downgrade notice, and a depositor base that read the same footnote at the same time made recognition unavoidable. The pattern recurs across this slate, a number that was always there, in a filing that was always public, that nobody treated as the headline until the headline could no longer be avoided. Next, on hidden liabilities, a banking middleware company, an 11-page consent order from the Office of the Comptroller of the Currency, and a sentence on page 7 that meant, in regulatory English, that the company had lost track of customer money, months before anyone outside the OCC knew the money was missing. Subscribe so you don't miss it.